In the last year, HYLD has changed quite a bit. New structure, new ETFs, new efficiency. The yield, well, it is still pretty darn huge, but now the foundation's stronger than ever. Hold on to your seatbelts, folks. This is going to be a good one. HYLD is one of those ETFs that keeps showing up in, well, both income and hybrid portfolios, and for good reason. They promote high yield, monthly distributions, and exposure to some of the biggest names in the US market. But what most people don't realize is just how much this fund has evolved since it launched back in early, well, 2022. When HYLD first launched, they were basically a middleman for income. Instead of managing their own strategy, they held US covered call ETFs. So these were funds that were already writing options on US stocks. That setup got investors quick access to high yield, but it came with some weight. Double layered fees, currency conversion drag, and almost no control over how those options were being managed. Hamilton was collecting income from someone else's system, not while they weren't running their own. So then came the pivot. And this is the important part. So back in 2024, Hamilton began swapping those US products for their own Canadian listed ETFs, each built to mirror the same exposures, but with full in-house control. At the same time, they dropped HYLD's management fee to 0%, removing that extra cost layer that used to eat into those returns. That move didn't just trim expenses, it let Hamilton fine-tune how the fund generates yield. Now, they decide the option coverage, sector mix, and leverage strategy themselves. In short, HYLD stopped renting yield and started manufacturing it, which makes them leaner, smarter, and far more efficient than the version investors first met. This redesign, it changes what HYLD actually is. It's no longer just a high-yield satellite play. It's become a potential core income engine. With its 0% management fee, in-house structure, and those consistent monthly payouts, HYLD now delivers efficiency and transparency that makes them far easier to fit into a long-term plan. In an income portfolio, they can serve as the primary cash flow generator, leaning on that enhanced yield while freeing up other positions for lower volatility holdings. In a hybrid portfolio, they can act as the yield yanker on one side of the barbell, balancing out growth or dividend growth ETFs that chase upside. The internal control also means Hamilton can align strategies across their ETF families, smoothing risk and distribution stability. It's still leveraged, still option heavy, so it's not set it and forget it, but for investors who understand how it earns, HYLD 2.0 finally looks like the version that belongs at the center, not just the fringe of a portfolio. A sub to the channel is the best way to lock in a high yield of future content. So that's the story behind HYLD's reinvention, a leaner, smarter version of the fund built to deliver income more efficiently. But, and I will always say this, talk is cheap and ETFs live or die by their numbers. So let's dig into the fundamentals and see if HYLD 2.0 is actually performing as strong as it appears on paper. So without any further ado, let's do this. We will begin as usual with our surface data, and the data used for today's deep dive, it is from the market open as at October 8th, 2025, in case you want to follow along. Their current value was coming in at $14.90, and they have an NAV of $14.85. Those net assets under management, oh boy, 1.02 billion. Nice. They have moved into the billionaires club. It's good to see. I knew they were going to get there, but it's good that they finally did. And this here is a pretty high volume ETF. So their average volume, according to Yahoo Finance, is coming in at 155,441. All right, let's talk about those fees. So I did mention earlier, they have a management fee of 0. That does not mean there's no fees, because their management expense ratio, that does come in 2.37%. Because HYLD is a fund of funds, Investors, well, they're still implicitly paying those MERs of the underlying ETFs. And in addition to that, there's also borrowing and leverage costs. So that all does get bundled into that MER. I think it's a pretty good deal, to be honest. So overall, I do think the surface data looks pretty good. I've got no complaints. So let me ask this question. What ETFs are they holding? Looking at their holdings, we have SMAX, which invests in US equities, QMAX, one of their tech ones, FMAX invests in financials, SDAY, one of the DayMax ones that came over. That one does invest in US equities as well. We have LMAX investing in healthcare, AMAX, which is investing in gold. Love that. We also have the other DayMax one, QDay, that came over, and that's also investing in tech. I will tell you right now, tech overall makes up 36.2% of their total basket. Continuing on, we also got EMAX in there, and that is their energy. And another one of my favorites is in here, RMAX, which is our REITs ETF. Of course, RMAX does give them a tiny bit of exposure to Canada in there as well. But for the most part, this ETF is very, very American focused. In regard to taxes, return of capital does make up about 70% of that dividend, and capital gains will make up around 17.5%. That can make this one fairly good tax-wise outside of a registered account. Of course, keep in mind, if you do sell it, that return of capital does lower that adjusted cost base, so you will have bigger capital gains somewhere down the road. Okay, I do think those holdings look pretty darn good. You know what? I want to see their returns and dividend data. So they have a yield of 12.03%. It is a monthly dividend of 14.7 cents per share. Now, incorporating the DayMax and SMAX into this fund, it is going to bring more income into it. So I would be really surprised if these dividends didn't go up, maybe even as early as their next declaration. And it may have already happened by the time you've watched this. We'll keep our eyes open for that for sure. Okay, switching to their returns. On their 3-year, that return on investment, it's coming in at 27.79%. Factor in those dividends, we get a total return of 69.67%. On the 1-year, return on investment 6.28%, adding in the dividends, total return 18.67%. And that gives us a 3-year annualized of 19.27%. I do want to address one thing in regard to those returns. That starting date on the 3-year, that was in the bear market. So as a result, that 3-year might be skewed a little bit higher than it should be. So that's just something to keep that in consideration for sure. But nonetheless, these are great numbers for sure. And I do think, I think we're ready for a final verdict on this one. HYLD started life as a yield chaser, an easy way to collect big distributions from US covered call ETFs. But the version we have today is a completely different animal. By internalizing their strategy, cutting the management fee to zero, and using their own Hamilton ETFs, HYLD has evolved from a patchwork of imported yield into, well, a purpose-built Canadian income engine. It's still leveraged, it's still option heavy, and it's not immune to volatility. But now it's doing exactly what it was designed to do. Deliver consistent high monthly income with greater efficiency and control. For income-focused investors, HYLD 2.0 can absolutely anchor a core income sleeve. And for hybrid investors who want steady yield without giving up all growth potential, it's a strong contender for that yield anchor side of the barbell. In short, HYLD, well, they didn't just survive the evolution. They came out stronger, smarter, and ready to earn their place in a modern Canadian portfolio. If you are interested in HYLD, then don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on the 0 to 100K challenge. Thank you for watching, and I will see you in the next video.